Stop what you're doing and pay attention, because the silver market is entering a moment that could redefine pricing, supply chains, and financial trust worldwide. If you ignore this warning, Monday's market open may catch you completely unprepared, as forces already in motion reshape global silver flows and institutional positioning. Friday marked a critical delivery deadline that many analysts dismissed, yet the underlying data reveals stress signals the mainstream financial media refuses to acknowledge publicly. The official narrative claims stability, but clearing data, vault movements, and widening physical premiums suggest a system straining to maintain confidence under extraordinary delivery pressure. Before we break down the numbers, comment your country and local time, because this unfolding event affects every region simultaneously as global markets respond in synchronized reactions. From North America to Asia Pacific, viewers are watching the same signals: vault drawdowns, physical premiums, and institutional repositioning that hint at a structural shift in silver market dynamics. The key question is not whether volatility is coming, but whether the current pricing mechanism can survive sustained physical demand colliding with limited deliverable supply. Let us examine the hard data behind Friday's deadline and why the exchange's apparent stability may conceal emergency measures designed to prevent a visible delivery failure. Open interest entering the delivery window represented hundreds of millions of ounces in potential claims, dwarfing the registered inventory designated for immediate physical settlement obligations. The futures market operates on the assumptions that only a small fraction of contracts request delivery, allowing leverage to function without requiring full physical backing. When an unusually large percentage of contract holders stand for delivery simultaneously, that assumption weakens, forcing exchanges and counterparties to scramble for available registered metal. Preliminary estimates suggest delivery requests approached levels that significantly exceeded available registered inventory, creating a shortfall that required alternative settlement mechanisms to maintain orderly market function. Such mechanisms may include cash premiums, deferred delivery arrangements, or off-exchange sourcing, all designed to prevent the legal and psychological consequences of an official default declaration. While these measures can preserve short-term stability, they often signal deeper structural imbalances between paper claims and the physical metal available to satisfy contractual obligations. Simultaneously, vault reports show metal-leaving exchange systems, indicating that some holders prefer direct possession or private storage, rather than exposure to exchange settlement risks. This trend reduces the pool of readily deliverable supply, increasing reliance on last-minute conversions or incentives to coax metal back into registered categories before delivery deadlines. Another critical signal comes from the widening spread between Western futures prices and Asian physical premiums, reflecting strong demand for immediate metal in key manufacturing regions. When industrial buyers pay significantly above benchmark prices, it suggests availability concerns rather than speculative enthusiasm, as production schedules depend on reliable access to essential conductive materials. Silver's role in solar panels, electronics, and advanced computing creates demand that remains relatively insensitive to price, because substitution risks performance failures and costly redesigns. Meanwhile, most silver production occurs as a byproduct of base metal mining, limiting supply responsiveness, even when higher prices would normally incentivize increased output from primary producers. Labor disruptions, environmental regulations, and declining ore grades further constrain supply growth, reinforcing a structural deficit that has persisted across multiple consecutive years. This deficit represents cumulative consumption exceeding new production, gradually eroding above-ground inventories that once buffered the market against temporary surges in industrial demand. As visible inventories decline, market participants become increasingly sensitive to delivery stress, amplifying price reactions when deadlines approach and physical availability becomes a central concern. Recent policy shifts in major producing and consuming nations have also altered trade flows, restricting exports, and encouraging domestic stockpiling to secure strategic industrial supply chains. Such policies create one-way flows, drawing metal into protected markets while preventing it from returning to balance shortages elsewhere, intensifying regional price disparities. The result is a persistent premium in regions experiencing acute demand, effectively acting as a magnet that pulls metal from global vaults toward higher-paying destinations. If this dynamic continues, Western exchanges may face accelerating inventory declines, forcing reliance on financial engineering rather than physical replenishment to maintain contract credibility. Market confidence depends not only on solvency, but on the perception that contracts can be honored with real metal, a belief that erodes when delivery stress becomes recurring. Investors must distinguish between price and volatility driven by leverage and structural shifts driven by physical scarcity, as the latter can redefine valuation frameworks across the entire metals complex. The events surrounding Friday's deadline illustrate how quickly sentiment can shift when data contradicts official narratives, prompting participants to seek independent verification and alternative information sources. Social platforms and independent analysts now play a growing role in disseminating real-time observations, challenging centralized messaging, and increasing transparency in commodity market developments. As more participants monitor vault flows and delivery metrics, the informational advantage once held by large institutions diminishes, altering the balance of power in price discovery. Despite these changes, institutional actions remain critical as large banks and funds control substantial positions capable of influencing short-term price movements and liquidity conditions. Recent positioning data suggests some institutions are reducing short exposure or hedging against supply disruptions, signaling a reassessment of risk in the face of persistent deficits. Such repositioning can accelerate price movements when combined with industrial demand, creating feedback loops that reinforce upward momentum during periods of constrained supply. At the same time, margin adjustments and trading halts demonstrate the exchange's willingness to intervene when volatility threatens orderly market function or clearinghouse stability. These tools can slow price acceleration temporarily, but they cannot create new physical supply, meaning underlying shortages may reassert themselves once intervention effects dissipate. Investors should therefore monitor not only price charts, but also inventory trends, lease rates, and regional premiums, which often provide earlier warnings of tightening physical availability. Lease rates rising sharply indicate increasing costs to borrow metal, suggesting lenders perceive greater risk in parting with physical holdings amid uncertain replenishment timelines. Similarly, backwardation in futures curves signals immediate scarcity, as buyers pay premiums for prompt delivery rather than accepting lower prices for future settlement dates. If backwardation emerges alongside declining inventories, it can trigger industrial hoarding, with manufacturers securing months of supply to avoid production disruptions from potential shortages. This defensive purchasing behavior reduces available spot supply further, reinforcing price increases and perpetuating the cycle of scarcity-driven demand across multiple sectors. Global macroeconomic uncertainty also contributes, as investors seek tangible assets during currency volatility, geopolitical tensions, or declining confidence in traditional financial instruments. Silver's dual role as an industrial input and monetary metal makes it uniquely sensitive to both economic expansion and financial stress, amplifying price reactions to complex signals. As we approach Monday's market open, attention shifts to Asian trading sessions, where physical demand often sets the tone for global price direction in precious metals. A significant gap between Western closes and Asian opens can trigger arbitrage flows, forcing rapid price adjustments as traders exploit regional disparities for risk-free profit opportunities. Such convergence trades can accelerate volatility, particularly when inventories are insufficient to absorb large-scale physical offtake, motivated by persistent cross-market price differences. Market participants should prepare for swift movements, recognizing that algorithmic trading systems respond instantly to price gaps, amplifying trends before human traders fully assess underlying causes. In this environment, risk management becomes paramount, requiring clear strategies, defined time horizons, and an understanding of the difference between short-term volatility and long-term structural change. Physical holders may prioritize security and storage considerations, while paper traders must evaluate counterparty risk and the potential for settlement disruptions during extreme delivery stress events. Diversification across forms of ownership can mitigate risk, balancing liquidity with the assurance of direct possession in scenarios where market functioning becomes impaired or restricted. Ultimately, the unfolding situation underscores the importance of independent analysis, as reliance on singular narratives can obscure critical developments occurring within complex global supply networks. By examining data from multiple sources, investors can form more resilient conclusions, reducing susceptibility to misinformation and improving decision-making under rapidly changing market conditions. The coming sessions will test whether current pricing mechanisms can accommodate sustained physical demand without significant repricing or structural reforms to delivery and settlement processes. If confidence holds, the market may stabilize, but continued inventory declines and persistent premiums could force a reevaluation of leverage ratios and contract specifications. Such reforms, while potentially disruptive, may be necessary to restore alignment between paper claims and physical reality, ensuring long-term credibility in precious metals trading systems. For now, vigilance is essential, as early signals often appear in niche data before reaching mainstream awareness, offering prepared participants a critical informational advantage. Your strategy should reflect your risk tolerance, investment horizon, and assessment of whether current stresses represent temporary dislocations or the early stages of systemic transformation. Share your perspective in the comments, including your region and the indicators you're monitoring, so this community can compare insights and refine collective understanding. Engaging in constructive debate strengthens decision-making, exposing assumptions to scrutiny and revealing alternative interpretations that may otherwise remain overlooked during fast-moving market developments. Remember, the goal is not to predict every price movement, but to recognize shifting probabilities and position accordingly, balancing opportunity with prudent risk management practices. As Monday approaches, remain attentive to inventory reports, regional premiums, and institutional positioning changes, which together provide a comprehensive picture of market health and direction. If physical demand continues outpacing supply, the resulting pressure may redefine price floors, altering long-term expectations and investment strategies across the precious metals landscape. Conversely, a temporary easing of premiums or inventory stabilization could indicate short-term relief, though underlying structural deficits may still reassert influence over extended time horizons. Stay informed, remain adaptable, and approach the coming sessions with a clear plan, because uncertainty favors those prepared to interpret data rather than react emotionally to headlines. This moment represents more than volatility. It reflects a potential transition in how markets value tangible assets, amid evolving industrial demand and geopolitical realignment. Thank you for being part of a community committed to critical thinking, data-driven analysis, and informed debate during one of the most consequential periods in modern silver market history.